Ladies and gentlemen.
Good evening.
Are you ready?
Okay, here we go.
You're listening to the Deal Room Podcast. Join us as we bring you the inside scoop on business sales and acquisitions. Get across trends in the area and hear the industry's best recount their real-life tips, traps, and experiences. Now, here's your host, Joanna Oakey.
Hi, Kerry. I'm so excited to have you back again. If anyone missed our first part of this two-part series, we'll have some details in the show notes about how you get back to that first part so that you can hear a bit about Kerry's background and a bit of an outline of the first company she purchased and how that process worked for her when she was forced to consider exit right from the beginning. But today with Kerry, we're going to be looking at the types of exit options available and the pros and cons of each. So welcome back, Kerry.
My pleasure. Thank you very much indeed for having me back.
Great. Our pleasure. Okay, so let's talk about these types of exit options that are available. So in your book, The $1 Million Payday, you set out a number of these options, and I just thought it'd be useful for us to go through these options in not a lot of detail, but maybe just summary form, just so that our readers can get a perspective on what your thoughts are about the advantages and disadvantages of the types of exit options that are available to them as they're running a business or looking to exit their business.
Absolutely. So I think I'll just sort of run through it in a bit of a list format first of all, in terms of the different sort of channels, if you like, that you could have a look at. And that would be, obviously number one could be selling to employees, which I described as the way that I bought my book in terms of a management buyout or a leveraged buyout. In terms of that's sort of key management. But then you could also sell to your employees in general, which could involve putting in place an employee share scheme in a whole range of different ways. So that's a little more complex. Obviously, there's family, and you could, have you could make a gift or have it so that the business actually pays you a bit of an annuity as time goes on. So you could also have co-owners who buy your business out. That could be a way for you being able to exit, at least release some of your business, some of your the value and equity that you have in the business. Obviously, third party is another way of doing it, selling off to a third party. An IPO, but very few business get to an IPO, to initial public offering. Obviously, that's a very highly profitable business that you would need to be able to get yourself to that stage. There's different ways of doing that through reverse listings and so forth, but I'm not going to spend any time on that. Obviously, another valid channel is to liquidate. If the value of the business and if you have assets in the business, machinery and so forth, and you can liquidate those, and that's a very valid way, and in terms of being orderly, we're not talking about foreclosing or anything like that, but we're saying just an orderly liquidation is definitely a valid way of considering it, and maybe restructuring, selling off perhaps some minority stakes, or maybe it's private equity, or you could do some refinancing. That's a basic list, if you like, of sort of the different ways and different channels that you could go. So
let's work through them and then, I think have a quick look at the pros and cons of each of these alternatives.
Sure. Maybe let's take a look at number one being the transfer of ownership, say, to family members. And because so many of our businesses in Australia are family businesses, I guess, and, this is the statistic that's around the world. And, there was a piece in the Fairfax newspapers not so long ago, back in September, from the Family Business Association, where they talked about the headline was the kids are set for a $3.5 trillion handover as, transferring the reins of family businesses to the next generation. So, this is definitely something that is pretty much top of mind, I'd say, for a lot of family businesses. So
and, look, I must say on that note, I have actually seen, I feel, a movement in the years towards, I'm just seeing a lot less of this transition to family members than I had been in the past. And I just wonder whether there is a trend that might be going on at the moment where it may be a plan of the business owner for this to happen, but the kids aren't so excited with the plan as time goes on.
Correct, absolutely. And I think there's there's a whole other discussion around that in terms of the challenges of being in families in particular. And if it hasn't been something that's been really openly discussed for quite a number of years and worked on, then it can be fraught with danger. And if there's assumptions going on that don't come out, that aren't addressed to be able to find out what's behind them, then you are definitely in dangerous territory. And yes, look, even in family businesses, that selling to a third party should always be an option that's on the table, no matter what, really, because you never know when, as Kerry Packer did when he sold Channel 9 to Alan Bond, you never know when the Alan Bond might come along in your lifetime. So be ready, So even good, strong, viable businesses, if they're not managed for sale, are often you won't get really what it's worth. So you have to really manage a business for sale, and that applies to whether, no matter what, if it's even if it's a family business, it should always be managed as if it's going to be able to be sold to a third party, because that's how you create the most value in it. So look, so the advantages.
So I think, go ahead. No, you go ahead with the advantages.
So I think if that's like the advantages are definitely that you're going to be keeping the business and the family together, and it's obviously that's an obvious one. You also should be able to provide financially for any sort of younger family members who are unable to earn a similar income from other work outside the family business. And that does happen. You could stay involved yourself, in the business at a much more relaxed level, and you might be able to orchestrate how much you need or want for the business rather than be told how much you will get. When you're selling to another family member, transferring to another family member. But then, of course, there are disadvantages, and, obviously you could have dissension with anxiety perhaps about unequal treatment among siblings if you're faced with that. Also, the notion of actually treating all of the children equally could be very difficult. Inevitably, one child will probably run or own the business at the perceived expense of the others. Usually, the family can't afford to meet a large cash payout, so the selling family member would probably have to live with payment over time, and of course, any associated risk if the business isn't continued to run profitably.
And this is one of the areas where I see key issues occurring, apart from, as I said before, the mere fact that, the concept of transferring to family members may be in someone's head and not in others. But the issue of not having the money for the purchase, effectively requiring payment over time, and then, the issues that can be involved with parents then relinquishing control over the business whilst they're still owed money by the business. I think that, in my experience, can be an issue that carries on.
Absolutely right. And it certainly can create some tension, and it also can really affect the business, and so it ends up being a self-fulfilling prophecy. The business gets run down because of all the other extraneous issues that are actually in there. And the owner doesn't relinquish control. They really still have to keep their finger on the pulse, or still find the need to keep their finger on the pulse, which again can stifle future growth, because perhaps the successor has all these great ideas, but mum or dad, whoever the majority owner might be, is sort of not really sharing the same growth mindset. So they're worrying about what comes in, to be able to support their continued lifestyle perhaps. But look, these are things, if as a family you really can. If you need to address these things early on, not leave them to the last minute. So, I mean, just as an aside, an example, I have with a client whose dad and son, son's only worked in the business for 5 years. He's in his 30s though. Dad's had a health scare, and he thinks, well, I've now got to start thinking about really moving on from the business, even though I might stay on for at least another 5 or 6 years. And Dad's accountant thinks the business is worth, let's just pull a number, $2 million. Son's accountant thinks the business is worth $1 million.
Oh, no.
So, even though they get along, and they really do, they get along really well together. Plus, we've got wives as well involved.
Yes, yes.
And so so there's a discussion that must happen around that, and a recognition that, well, how can we come together on what we believe is the right value for the business, and B, how can we afford to pay you out? What sort of plan can we put in place to be able to pay you out and support you? So, yes, look, family businesses have all those extra issues to really deal with, and I mean that even happens with business partners too, whether they're family or not. So, yeah. But look, in terms of transferring ownership to family members, it's really important to start talking about it early on and making sure that you do have the right person in place, to be able to do that and address the other attendant potential conflicts that might arise, in the future.
Yeah.
So perhaps the next one, it could be to sell to other shareholders. It's not necessarily an option that every business owner has, and it may be that you're the sole shareholder. So in many respects, that's a good thing because you can make the decisions, So, but I do find too, in particularly in private businesses, especially smaller private businesses, that there the owner might perceive themselves to be the only shareholder, but they have their partner, it's their spouse in the business as well. So they do have to think about this, depends on the structure. But obviously, if you do have other shareholders in the business, you could in fact sell the business perhaps to one of the other shareholders. That's a good thing, because the business then would stay in the extended family. And if you've been well prepared and you've set it up with a buy-sell agreement, which sets out what's going to happen if one or more shareholders want to leave the business, and then it's really makes it a lot easier. I can't tell you how often, and I'm sure you've seen this too, Joanna. I cannot tell you how often I've come into a business and, there's 2 or 3 shareholders and they haven't set up a buy-sell agreement. Oh, boy. Anyway.
Yeah. And look, and I think the issue here that I see time and time again is that trying to work out what the terms would be on sale feels very difficult at the beginning. But I tell you what, it can often be a hell of a lot more difficult if you don't do it at the beginning. If you're leaving those decisions, it doesn't get easier to work out value and equity and equitable distribution and how it's going to work and how the rights will work. It just gets harder if you don't do it up front, is my experience.
Oh, totally. I couldn't agree with you more. And it could actually make for a much lengthened process. It can be very protracted, and you're totally distracted, from the business while all this is taking place. So certainly, a well-prepared shareholders agreement can easily facilitate the transfer process. So it's, there are definite advantages to be able to sell to a fellow shareholder, not the least of which as well is the fact that the process of due diligence is very much reduced because, they know what the business is about. So little or no disruption to the business. Yeah. We've talked already about, one of the disadvantages if you don't actually have a shareholders agreement in place, then it could be a very difficult negotiation, and it might force you to take a price that's actually not really reflective of the company's fair market value. So anyone listening who doesn't already have an agreement, speak to Joanna, get in touch and get something going.
Thanks, Kerry.
Yeah, absolutely. But then again, one of the disadvantages could be, of course, that you're locked into selling your shares only to, say, a fellow shareholder, and it could create a limited market and, thereby depress the company's value. But again, I'm sure if you've used Joanna's team, they'll have addressed that in allowing other opportunities as well. Yep. But you might not necessarily get the maximum price, but sometimes there's a trade-off between getting a slightly higher price and the actual process. So you're discounting perhaps for that reason. So, that's just something else to consider. Also, too, it might just depend on how it can be funded. That's the other thing. So, again, it might require, you might be, as the selling shareholder, you might have to take, a note, as they say, and, have some of the money still in the business so that the business can pay you off over time. So that could be a disadvantage to you, when considering that sort of arrangement. So then the next one we talked about, and I described in our previous podcast about selling to management or key employees in the form of a management buyout or leveraged buyout. And, you can either sell, all of it or part of the business that way. And perhaps over time it could come into it. Again, an advantage is, of course, it stays in the extended family. They know the business, so it does make that transfer process a lot easier. And you don't have to go out and really do on a roadshow to try and actually sell it off to another third party. So there's less risk usually in that sort of situation because the management's not disrupted and they can continue to carry on the way that they've always done. So it makes it for a very smooth transition and sort of very little disruption. Also, that sort of partnership with an equity investor can provide additional growth capital that you might not otherwise have for the company. So you may not necessarily be exiting totally, but you're just exiting a portion. You're selling a portion of the business. So, that's a few of the advantages. In terms of disadvantages, it could be that a lender might need everybody, to contribute a certain percentage in equity, and maybe that could be a problem if you're talking about selling off a portion. If, in fact, the management team needs other external financial help to be able to actually fund the acquisition, then that again could result in certain conflicts. So, and again, if the company doesn't have perhaps sufficient assets to be able to leverage any finance that might be required, then that could create an issue. And I did talk about it before in terms of the owner may have to leave some equity in the business and might have to it's almost in a form of vendor finance, if you like, leave money in the business to be able to be paid off over time, so which is always a risk. So.
And in this sort of option, if you're still leaving money in the business, I guess one of the benefits of this sort of approach is that it gives a way for you to get your key employees more invested in the business in terms of, and I know we're about to talk about employee share schemes or ownership plans, which are a different version of this management or employee buyout. But obviously, if there's an option that your employees can see that they might be able to be working to into the future in terms of an equity arrangement, even if that's them buying the equity, sometimes that can really help retention of high quality staff.
Absolutely. Couldn't agree more. I think it's definitely something well worth considering, and taking into account the future impacts that will have as well. So definitely a way of what I would call it a golden handcuff, that keeps key employees involved and really looking forward to dividends as they come down the track, and to be able to just to have more of an interest and be educated more from that perspective as well, to understand what it's really like to be a business owner.
Yeah. Okay, great. So that's the management buyout or employee buyout. But then slight variation on that, I guess, is the employee share schemes or the share ownership plans.
Sure.
Which can have many different forms.
they certainly can. And I would say that you really would need to be of a certain size to be able to consider taking this on, because it is quite a long-term approach, and there are many issues to consider. And in my book, I do give you a few sort of clues, if you like, as to some of the advantages and disadvantages. So that, obviously advantages are that it does stay in the extended family because you've got your employees involved. And it is an employee benefit. You clearly need to be making good profits to be able to make this attractive for employees to even want to have anything to do with the business. And with a bit of luck, you will be able to make them think like owners rather than just employees. I say just, but rather than employees, because there is a different psyche involved in that. Certainly, from a taxation perspective, there are benefits that you'd need to have a look at. The way our tax system changes, though, they change fairly regularly, so you have to keep on top of it. And there are certain loan plans that can be put in place for employees if you make loans for the employees to actually purchase the shares. So, those are things that really would need going into in some detail with expertise that really understands what you're up for. If you're going to implement an employee share scheme.
And I think, in relation to employee share schemes, and I think, at base, the real difference between this and the last element we were talking about a management buyout or key employee buyout, is that the employee share schemes are generally a type of arrangement that is more widespread throughout an organisation rather than, say, the management or key employee buyout. But for the employee share schemes, one of the things that, business owners have to have in their mind is, how are you going to deal with situations of when employees leave? Because, sometimes in employee share schemes, they might be given to employees as a bonus, for example. Sometimes they might be purchased, sometimes not. But there's always this issue, what if the employees leave? So they're the sorts of things that I guess you need to think through.
You certainly do. And also, the same thing applies to even if you have equity partners who are shareholders in the business. What happens if they do leave the business? So you do really need to consider this, the impact of anything like that, and what your policy is if that occurs. So, and I've recommended in my $1 Million Payday book, I've actually recommended another reading, which is from Jack Stack, who wrote a book called The Great Game of Business, which is since updated, and 35 years after implementing his employee share plan, which he put in place to grow the business, he is still in the business. And I know from his sort of updated book and the reading that one of the issues he faced was how was the business actually going to fund the retiring employees, because the effect that the ESOP had with his business was to have people stay on for years and years and years, and it became a great way for them to actually innovate and spin off lots of other businesses that employees had thought about, and they were able to fund internally, as it turned out. It's a great read, really well worth reading. But then, of course, the issue that arose later on was, well, hang on a second, now we have all these employees who've been here for so many years, and the value of the shares in the ESOP have gone up substantially. How are we going to fund their payouts from internally within cash flow of the business? So required a lot of consideration, and for them restructuring around how to do that as well. So it's definitely an option, but it's certainly quite a complex one. Yeah.
Let's take a short break. When we get back, Kerry continues through her list of business exit options, starting with the number one choice for business owners right now. That is selling to a third-party buyer. And that can mean either selling to a competitor or a customer or a supplier or whatever. Then, of course, we'll identify 3 more types of exit channels for business owners in order to complete our list of 8. And that's next. I'm Joanna Oakey, and you're listening to the Deal Room Podcast, brought to you by Aspect Legal. Aspect Legal has a number of great services that help businesses prepare for a sale or acquisition, to help them prepare in advance and to get transaction ready. We've also got a range of services to help guide businesses through the sale and acquisitions process. We work with clients both big and small and have different types of services depending on size and complexity. We provide a free consultation to discuss your proposed sale or acquisition. So see our show notes on how to book a time to speak with us, or head over to our website at aspectlegal.com.au. Welcome back. Earlier, Kerry talked about the first 4 types of exit options that business owners can consider. These were number 1, transfer of ownership to family owners. Number 2, selling to your other shareholders. Number 3, selling to management or key staff. And number 4, selling to employees via share schemes. Now, let's continue our conversation with Kerry and talk about 4 more types of business exit options, the pros and cons for each type, and some tips about what you ought to consider for each one. And so I think our next item on the list is sell to a third party. And look, I think this is quite fascinating that quite often business owners will think, or anyone really, when you talk about what are our exit options, they'll have sell to a third party as number 1 on their list.
Yes.
And here we are at number 5.
That's right.
and tell me about the order here. Being number 5, is it because you're challenging business owners in terms of thinking about what other options there are, or do you think that it's it's the thing that you should think of after you've thought of each of these other options first?
I think I'd like to lay claim to that there's some real process in the 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And there is to some extent. But yeah, look, I think first and foremost, family businesses are the number 1 business. That's the structure of so many businesses now. Basically, the number 1 structure for small to medium enterprises has been that they're family businesses. So obviously, you're going to think about it, if you like. That's why I went to number 1. That selling to a third party can always be top of the list, regardless. But because most of our businesses, or the greatest majority of the businesses are family businesses, so thinking about those options at the beginning is well worthwhile, notwithstanding that even for family businesses, selling to a third party is definitely one of those options that should always be on the table, regardless. So look, if we look at that in terms of a channel and an exit option that you can take, it's clearly important that you really have done everything you possibly can to increase the value of the business. So you make sure that you've got several years of financials that show really good profits and growth. If you've been running your business as an income stream where have what might be termed as private expenditure going through your business, then make sure you've restructured for for many years to make sure that has been sorted.
Cleaned up the accounts before.
Correct. Even though people say, "Oh, well, what are the add backs and all this sort of thing?" You don't want to present financials that have got questionable numbers in there. They need to be really nice and clean. So. But look, selling to a third party is finding a buyer. So they could be a competitor, they could be a customer, they could be a supplier. There could be. So people, if you call it a strategic buyer, I can give you an example. A couple of years ago, with a client in Sydney who they were in the pest control business. Now, the pest control industry went through what's known as a roll-up. So they were able to sell their little business, which was a very successful business that they'd been running for 15 years. They got 10 times multiple.
Gosh.
So they actually sold the business for the revenue of the business because the big company, it's a multinational, saw the opportunity to, and they weren't the only one, they went around buying up a whole range of small businesses to be able to exponentially improve the market share that they had. So they were not necessarily looking to buy the infrastructure of that business. They rolled it up into their own, and so what they really wanted was the client base. So it represented a great deal to them. That business was really well run. They had everything at their fingertips and were a stellar. They were a standout in their class. There's no doubt about it. So, everybody would love to go for a 10 times multiple, but it's not necessarily realistic. But if you manage to find yourself in a market where there is that sort of acquisition process going on, and you'll know in your own industry, then there's an opportunity to be able to sell for probably maximum value, to a strategic buyer. Another possibility could be that there's a private equity group, depending on the size of your business and what the future growth trajectory could be, or the type of technology that you may have. In my book, I tell the story of Skybridge, which is a fabulous, what was initially a very small business that they were able to sell to a private equity group for multi-millions, and the owner was able to exit successfully. And that was almost walk in, walk out, where they didn't actually want him necessarily involved, although he has retained a small 10% shareholding, which I know he said to me, I'm hoping they're going to turn my 10% into what I've already got, for the other 90%. So that's another option, as a third-party private equity group.
And I think that that part of the book, I think, is it might be particularly useful for business owners who haven't had a lot of exposure in this area to read, because private equity, I think some of the concepts that you talk about in that chapter are maybe elements that business owners may not often be exposed to. So I think that particular component of this chapter is useful for business owners that are listening to have a bit of a read of and get across the options and opportunities in that area.
Correct. That's right. So look, in terms of advantages, if you're selling to a third party, obviously, usually here the main advantage, of course, is that you're going to receive the majority of the purchase price in cash at the time of closing the sale. Although often some is held back, and it can be, subject to performance under any sort of new ownership, but that's hopefully one of the advantages that you can negotiate in the first place. So, and usually because natural market forces, you're going to get a higher valuation than you perhaps might be, if you were selling internally to family or management. And potentially it is the only exit option that gives you access to buyers with a strategic or synergistic motive, as I spoke of before with the little pest control business. So, and that obviously leads to a sale at a premium, to what might normally be fair market value. You'll get a little bit more. But in terms of the disadvantages, you might have to stay on for a while. So in my case, I had to stay on for 2 years. And that, is not an easy situation when you've been calling the shots and then all of a sudden you're now an employee. So, and with its attendant reporting requirements and everything else. And that can often be difficult. So,
and I think business owners often underestimate that process as well, and forget what it feels like to work from someone else, forget what it feels like not to be the boss, calling the shots. So,
yeah, absolutely right.
That is important to bear in mind.
It is. It's very important. Of course, the other thing could be that you might have to still leave some money in the business, and that, a certain portion of it is going to be, you're actually going to be earning it out. So it's an earn out, so over a period of time. So if you haven't approached that in the right way, then you are potentially leaving some of that in there as a risk. So it could be that, say, 20%, gets left in, and you have certain performance requirements over which you now have no control.
Yeah.
So these are some of the disadvantages anyway. So. And another way of looking at exit is, in fact, to refinance or recapitalize the business. And one of the areas that I really like to highlight for people is that most small to medium businesses don't look very much at their capital strategy, and that's something to put on the make a note about and put down, because if you do want to grow your business, recapitalising means finding ways to fund the company's balance sheet through being able to grow the business. So you could leverage your assets. If you like, you might have some sort of debt arrangement that can provide some partial liquidity for you, but you really are looking at a growth strategy as well. But that's for you. You're exiting and getting some of your capital out in order to continue to grow the business. Really, that's a way to look at that from a really positive perspective. So, I mean, you can have the same type of arrangement with equity investors, but you can maybe. That's a way of cashing out, some of your shares by having sort of external equity investors as well. So the advantages, you can maintain your equity interest in the company and you can participate in its future growth. So you will get a multiple even of what you've still got left in the business. So you can take some of your money off the table. That's the most important thing. And I think a really good example of this is one that I'm sure everyone listening to this will relate to, and that's Janine Ellis at Boost Juice. I think the numbers now, she actually has only 28% of the company now. So she was able to sell her she took some money off the table with a private equity firm actually coming into the business, and she's done that twice now. She's sold down her shareholding. So so refinancing, recapitalising the business with external equity, that is definitely an advantage, and you can remain actively involved, in the management and the growth of the company. So unlike having to sit there and just have an earn out where you are not in control and yet expected to reach certain milestones.
And as you said, I think in the previous podcast we had, perhaps a lot of this also comes back to, what are the outcomes that you're looking to achieve? Is it that you're just looking to cash in to some degree, or is it you're looking to create a lifestyle opening?
Correct, exactly. So, I mean, that's a valid exit option, is actually having a lifestyle business. So you do maintain your a reasonable percentage of equity in the business, but it continues to maintain a lifestyle for you. Absolutely valid way of being able to exit the business. So, I guess perhaps one of the disadvantages with this sort of type of refinancing or recapitalisation, if it's in fact debt that's used to create liquidity, that the increased leverage or debt burden might actually affect the company's performance, and it might make it a little more risky. So that's certainly one of the disadvantages. You might have to give a personal guarantee as well to accomplish what you want to achieve, but that certainly exposes you to risk, and maybe the lender might not live up to their end of the bargain if it actually involves some sort of participation in the business, and so that puts you under a lot of pressure that you didn't really need to have. So anyway, there's definitely a viable way of being able to take some money off the table, to be able to sell down your equity, cash in a little bit of your equity. We mentioned as well before going public. So clearly you require of a certain level of profitability before you can even consider going public. And obviously that helps you will definitely give you additional capital. It's an expensive process to go through, but it certainly creates liquidity for you, and certainly key managers and employees. You'll certainly have a higher profile, than private firms, and it's a way of being able to offer your employees some shares that can be liquid, although depending on the size of the business, that also can have some hooks on it as well. Valuation multiples for public companies are significantly higher generally than multiples paid for similar private companies.
And essentially that's it, isn't it? There lies the reason why businesses, think about this concept of maybe an IPO. But I think it's really important that we focus on the time and energy that's involved. But there's big potential payoffs at the end for that.
Oh, definitely, absolutely, definitely. And we read in the press and online all the time the stories about those that have gone public that are successful, and the odd occasional one that isn't successful.
Yes.
But that if you're of a certain size, that is the ultimate, in terms of being able to take some money off the table and create liquidity around your equity in the business. It's definitely worth considering, but you really do need to be doing 10 to 40 million, and be able to be churning at least 3 million. I think it's $3 to $5 million on the bottom line, it's certainly not an option that's available to a lot of private businesses.
And then finally here, I guess, is number 8, the sad, liquidate the business. But as you say, and I think earlier you had a positive spin on it, it might be a way for organisations to take the assets, liquidate the assets that are sitting there in the business. And it's a reality, isn't it?
Totally.
Of all the number of businesses that, are coming up for sale, as we've talked about in earlier episodes, in the next decade, there will be a large portion of businesses that will have to go with this option.
There will be. And closing the doors is an option. That's exactly what it is. If you are in a business that has physical assets that can be liquidated, and the value of those physical assets is greater than the amount of profit that you're making, then obviously liquidating the assets is the best way to go, because you're not going to get as much for the business as to try to sell it as a going concern as you would for, say, liquidating the assets. If it's it could be commercial buildings. I mean, it could be equipment. It could be a whole range of physical assets in particular that will be worth more to you than trying to actually sell the business. So an orderly liquidation is a very, very viable exit option. And you just need to, as I said, the emphasis is on the word orderly, okay? Yeah, because, you still do have to go through a process. It's not just simply a case of just shutting the doors and putting a for sale sign up on the, assets.
And for many business owners, I think, thinking about this list of the options of how they can exit, of course, a lot of business owners feel that their business is a large asset, a large value asset for them in their asset pool. But some business owners take money out of the business on the way. And, for them, perhaps the concept of liquidating the business, the business has had its usefulness during its life cycle in terms of the income and lifestyle that it's been able to help the business owner generate during that period of time. So for that business owner, perhaps this option isn't such a bad option if indeed they can't see how, or they don't want to put in the effort to transfer it into something that is of value or saleable to a third party or any of these other options that we're talking about. Because all of these other options that we're talking about involve effort, don't they? The reality is it involves time and effort getting your business in the state that it's ready to do any of these other exit options that we've talked about.
Absolutely, it does. Correct. Absolutely. That's why it is certainly a viable option. But then again, if you don't have physical assets that you can sell like that, or intellectual property assets that you can sell, then spending time to actually create value and grow the business and make it saleable is well worth investing some time and effort in.
Yeah, absolutely. Well, look, that is a fabulous rundown of those 8 different exit options. So just as a quick rehash, we talked about transferring ownership to family members. We talked about selling to other shareholders. We talked about selling to management or key employees. We talked about selling to employees via employee share schemes or share ownership plans. We talked about selling to a third party. We talked about refinancing or recapitalising the business. We talked about IPOs, and finally, if all else fails, we talked about what you're left with, which is probably liquidating the business. So thank you so much, Kerry, for that run through of, of all of these options. From your experience, which option are your clients gearing themselves up for most often?
Most often it is actually to look for a third-party buyer.
Yeah.
Yep.
Well, and look, and I guess people who are coming to you are the people probably that have gotten themselves into the position where they feel that they don't want to liquidate, they don't want these other options, they want value, they want to receive the value for the asset that they've built up over all of these years. So, I guess that makes complete sense. And of course, that's also our experience here, but I just thought it'd be interesting to hear what you're seeing from your side on the street. And sell to third party still comes in as number one on the list of most used exit options, I think.
Yes, it does. It does.
Good. Okay. All right. Wonderful. Well, look, thank you so much for your time again, Kerry. It's been very illuminating. And if people want to find out more about the services that you offer, or to get themselves a copy of one of your 2 fabulous books that are all about exit strategies, where should they go?
Simply go to my website, which is theexitstrategygroup.com.au, and you'll find there on the top of the menu there's a link that says books, and you can certainly order them. Both books themselves are complimentary. It's just postage and handling for the $1 Million Payday book of $9.95. So, theexitstrategygroup.com.au.
Great. Wonderful. Thanks, Kerry.
My pleasure.
Ladies and gentlemen.
That will conclude this evening's entertainment.
Thanks for listening to the Deal Room Podcast. To find out more about this episode and other episodes in the series, check out the show notes or head over to our website at thedealroompodcast.com.au.